the reason we're in this situation is because the Fed started quantitative easing, meaning they were buying assets, they were buying treasuries, buying mortgage-backed securities, which puts liquidity into the markets, and they were keeping interest rates, really, really low, which encourages risk taking. And when capital is looking for yield, if they can't get a good yield in treasuries and they can't get a good yield in banks or things like that, or annuitized income, they have to go to risk assets. So that's what drives the markets. That's what drives real estate. And real estate valuations in specific are based on two things: the availability of credit and the cost of that credit. And in 2008 and 9, both of those dried up. Rates went up, credit dried up, and that's why the real estate market tanked. So that's the business cycle in a nutshell. And where we are right now is we're at the peak and we're rounding over the cliff. So this is the equivalent of about probably 2008 going into 2009. And the big question is, are we going to go into a recession? How deep is that recession going to be? How long is it going to last? And what's it going to do to credit markets with what the Fed's been doing with interest rates and the pressure that the banks are under? And we don't know the answers to those questions because it all hinges on inflation. And we all know, everybody watching this, almost nothing has come down. Everything still seems to be up. Gas fluctuates a little bit. Automobiles were down a little bit. Now they're back up. Then they were down a little bit. I think, the automobile industry is kind of rolling over now just because of the credit markets that's drying up in automobile finance and people defaulting at record levels on automobiles. And then you have the commercial real estate market with a lot of commercial real estate assets, specifically office, that are underwater. It's difficult to get debt for those assets. Multifamily, residential, other real estate assets, you can still get debt. You can still get attractive debt at decent rates. We'll have Simon speak to that in a minute because he's actively securing debt in the markets right now. But we're in a risk-off environment where you have to be mindful of risk, and you have to be in preservation of capital mode and be ready to take advantage of opportunities as they come along with distressed assets, because that's kind of the cycle that we're in. And if the Fed can manage to get inflation down, we don't go into a deep recession, interest rate policy can kind of level off, then we might be able to avoid all that. Then we get into a new norm of higher rates than we're used to and that we've seen for the last, it's been probably 4 or 5 years, since rates have been at 5%. But that's normal. In my history of investing and developing, Fed funds rate were always around 5%, and interest rates as a developer were always in the 7 to 9% range. So to me, those were normal rates. The problem is the valuations have not adjusted to the interest rate environment. So it's going to take time for that to work out over the next 12 to 18 months.